Hello there. This is Brian, presenting for Capital Management Institute. Futures contracts have an expiration date. Futures on stock indexes and U.S. Treasury bonds expire quarterly. In general, the front month, the contract that'll expire soonest, is the active contract, the contract with the highest volume. However, due to the planting and harvesting cycles associated with agricultural futures contracts, this is not always the case. You should always trade the active contract in order to maximize liquidity. When a futures contract expires, it'll do so on the third Friday of the expiration month. All futures contracts that expire that month will expire at the close of business on the third Friday. The week that ends in the third Friday is labeled the rollover period. Rollover is when traders transfer their positions to the next active contract in order to avoid delivery or receipt. You should start using the next contract a few days before expiration Friday. In the first video, we talked about some of the common futures trading symbols, like ES for the S&P 500 E-mini futures contract. The symbol ES is called the root because futures contracts also have a suffix which tells you when it expires. The first character after the root is a letter that tells you the expiration month. H is for March, M is for June, U is for September, and Z is for December. The next two characters are the expiration year, so 2012 would be 12. Thus, an E-mini S&P 500 contract expiring in December 2012 would be abbreviated as ESZ12. You should generally open a trade with a futures contract that will not expire before you intend to close it. If necessary, you can roll your trade into the next contract. But be aware that the price associated with different contract months tends to vary. The price differential for varying contract months is known as the spread. The reason that back month contracts are a different price than the front month contract is because of fair value for equity indexes, storage costs for non-perishable products, and temporary shortages or surpluses for delivery-based products. Seasonality can also be a factor. Let's look at each of these briefly. Fair value is a term applied exclusively to equity indexes. These equity indexes are composed of various groupings of stock, like the S&P 500 or the Dow Jones Industrial Average. Fair value is an adjustment based on the cost of borrowing money and the dividends that you could have earned if you had bought the actual underlying stocks rather than the futures contract. Seasonality is the effect of the weather on the price of a futures contract. For example, heating oil prices are higher during the winter, and gasoline prices are higher during the summer driving months. Equity futures are known to decline during the summer vacation months and rally during the Christmas shopping season. Storage costs are why corn for sale in the winter or spring costs more than during the harvest season. It costs money to store corn, and this cost is reflected in the contract price. For delivery-based products like corn, wheat, oats, and light sweet crude oil, back month futures contracts may be priced with contango or backwardation relationships. A contango occurs when the front month price of a commodity is lower than the back months. For example, if corn for delivery next year is 10% higher than corn for delivery next month, the corn is in contango. Backwardation is the opposite of contango. Backwardation occurs when the back months of a futures contract are priced more cheaply than the front month. Backwardation could occur from a drought causing a short-term spike in corn prices, with expectations that prices will recover as time goes on. Backwardation and contango are caused by differences in expected supply and demand between the present and the future. Futures contracts are traded on different exchanges than stocks or options. The Chicago Board of Trade, or CBOT, is the first and oldest futures exchange. Founded in 1848 to relieve the problems farmers in the Midwest were having connecting with buyers. By 1864, the contracts were standardized and called futures contracts for the first time. At the CBOT, farmers could deliver their grain this year and sell contracts to deliver next year's crop before they went home, locking in a fixed price and a guaranteed buyer. In 1898, the Chicago Butter and Egg Board was founded, and eventually expanded and changed its name to the Chicago Mercantile Exchange, or CME. The expansion was inspired by a number of minorities, like Armenians and Jews, who were not allowed to become traders at the Irish-controlled CBOT, but were eager to trade more than just butter and eggs. In 2007, The Chicago Mercantile Exchange had grown to become the largest futures exchange in the world and bought the Chicago Board of Trade. Some futures exchanges were later opened in New York. The New York Board of Trade, or NYBOT, and the New York Mercantile Exchange, or NYMEX. The NYMEX is currently owned by the Chicago Mercantile Exchange, and the NYBOT is owned by the Intercontinental Exchange. The Intercontinental Exchange, also known as ICE, is a younger electronic-only marketplace. The Chicago exchanges trade the largest variety of futures contracts in the widest range of markets. Some of these include currency futures, fixed income futures, meat futures, agricultural futures, and stock index futures. New York exchanges trade precious metals, petroleum products, and a group of agricultural products known as the softs. The softs include cotton, cocoa, coffee, sugar, and orange juice. Settlement is the act of completing or fulfilling the contract. Some contracts are cash settled, and some are settled by physical delivery. Cash-settled contracts use some external reference to settle the contract value between the buyer and the seller. Equity index futures are cash-settled based on the closing price of the index on the settlement date. With delivery-based contracts such as corn, a trader will be expected to make or receive delivery if they have an open position at expiration. In futures trading, there are only buy and sell trades. If you want to go long, you do a buy transaction, and then to close it, you do a sell transaction. If you want to go short, then you do a sell transaction, and then to close your short, you do a buy transaction. Let's take a look at a real-world example. Say you own a Mercedes-Benz car dealership, and you needed to place your car order 4 months in advance. You expect to buy 30 cars in at an average price of 50,000 euros per car. However, you must sell them for dollars, not euros. At the current exchange rate of 1.20 to 1, you'll need to pay $60,000 per car, or $1.8 million in total. If the value of the euro rises to 1.25 in the next 4 months, then you lose $90,000, which is a large part of your profit margin. By buying 12 contracts now, you can lock in the current exchange rate. Since the euro-dollar futures contract is cash settled, you'll receive $90,000 from the futures contract settlement if the currency exchange rate does rise to 1.25. On the other side of that transaction may have been a French company whose interest was the opposite of yours. This process of locking in a future price is known as hedging. Hedging is a method of reducing or transferring risk, and is the primary reason for liquidity in the futures markets. The idea of a futures contract can be expanded to many situations beyond the obvious. Imagine a large office complex owner in Chicago who wants to hedge his winter heating bill against a cold winter. On the other side of that trade may be a supplier of natural gas who wants to hedge against a warm winter in Chicago. There is a weather contract for Chicago that can bring them together. Thank you so much for listening to our presentation on trading the futures market. Please feel free to visit us often at www.capitalmanagementinstitute.com.